Well, I think we all know, for the most part, what it means to purchase stock. So you're purchasing this stock, you're putting it within your portfolio. That's being long. On the other hand, a little bit more complex is what's called being short stock.
Hey, I'm Desiree.
And I'm Denver.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we're walking through the basics of stock trading. Don't worry, you did click on a video about options trading, but to understand options, you've got to first understand the basics of stocks.
Exactly. An option is always connected to another financial instrument, like a stock, and this is why an option is considered a derivative, because it derives its value from something else. Not to mention, an option can lead to owning or selling shares of stock. So, even if you're confident in your stock trading abilities, this video will help build a foundation for options topics we cover in the future episodes.
And meanwhile, in this episode, we're going to break down the basics of stocks. What is a stock, and what does it mean to be a shareholder?
Then later on, we'll walk you through examples of both long and short stock positions, talking about potential risk and reward of each. Finally, Obi and Kendall will show us how to look up a stock on the Robinhood mobile app. But first, let's answer a fundamental question. What is a stock?
Stock represents ownership in a company, and it's traded in units called shares. If you own stock, technically, you're a part owner of the company, and that makes you a shareholder. As a shareholder, you can make money in one of two ways: price appreciation and dividends. First, price appreciation means that a stock's price has risen since you purchased it. Stock prices fluctuate throughout the day, but investors who own stock hope that over time, the stock price goes up. Keep in mind, you don't technically profit unless you sell your shares at a higher price than what you paid for them. And despite what you may have heard, stocks don't always go up. In fact, many stocks lose value, and some companies even go bankrupt. When that happens, investors may lose part or all of their money. The second way to make money from owning stocks is by collecting dividends. Dividends are payments from a company to its shareholders, giving them a portion of its profits. It's important to remember, not all stocks pay dividends, and even those that do can suspend them or reduce the amount of the dividend at any time. Let's pass it over to Obi, who's going to tell us what it means to be long or short shares of stock.
All right, so let's break down what it means as the buyer of stock to be quote unquote long stock. And what this means is that we were the buyer of stock, meaning we bought it. This means, of course, we own the shares. And many traders will refer to this as being long stock. So if you hear long stock, just think of it as someone who owns shares of the stock. Now, when we own shares of stock, we're bullish, which means we want the value of the shares to rise. So let's say we owned XYZ at $50 per share. Now I'm just gonna make a mark right in the middle of the x-axis at $50, which is our break-even or cost basis for what we paid for the stock. Now, where do we make money if the stock goes up, right? Well, remember, we own 100 shares, so let's imagine the stock went up $1 in value to 51. If the stock goes up $1 because we own 100 shares, we now have an unrealized profit of $100. Now, what if the stock goes up forever? Well, technically, if you own shares of stock, the theoretical profit when you own stock is the stock can really go up to infinity. Now, that's not necessarily the case in real life, but from a theoretical standpoint, if the stock price just kept going up, we would have infinite profit potential. So what we call this is if our max gain on the position for owning shares of stock is unlimited. Now, what about the downside, right? What happens if the stock goes down? And trust me, stocks do go down, and so we have to always worry about that risk. Well, if the stock goes to 49, there we go. Just like on the upside, if the stock goes down $1, well, we lose $100 if the stock goes down. Now, what's the most we can lose on shares we own? Well, it's technically what we paid for the stock times however many shares we own. So if we drew this all the way down to zero, we know that the max loss we would have on the stock position is $5,000, which once again our max loss equals our purchase price times the number of shares we own, which is 50 times 100, and that's how we arrive at a potential max loss of $5,000. All right, let's look at the same example that we just did, but now from the perspective of someone who is short stock. So when we're short stock, remember, we've borrowed the shares and we have sold them short, which is simply an expression meaning we have to return them. We are short those shares and we owe them to someone else in the future. And so when we say short stock, we are short shares. This is a bearish position. Just in the opposite of long stock, which was bullish, right? We wanted the stock to go up. We want the stock price to go down in value so we can buy them back cheaper and return those shares to the person that lent them to us. So let's look at our example. Here we have a position where we are short shares, and in your brokerage accounts, you might see this notated as a minus 100. So I'm just gonna notate minus 100 XYZ at $50 per share. If the stock goes up, we will be losing value above 50. If the stock price goes down, we will be potentially profiting below 50. And we're gonna start at our $50 break even. Now, if the stock value goes down $1 to 49, we are gonna be potentially making $100. So what's our max gain on a short stock position? Well, a stock can only go to zero. And so if we sell at 50, and let's just say theoretically the stock went out of business and it was worth zero, we would theoretically have a profit of $5,000. Where do we get that? Well, just like in the previous example, we're taking our short share price, in this case $50, times the number of shares that we are short, which is 100, and there we get $5,000. So there's our potential gain on a short stock position. Our reward is to the downside, but where is our risk? Well, this is very important. Listen very closely. When we sell shares short of a stock, well, stock can go to 51. We're down $100. If the stock rises to 70, we're theoretically down $2,000. And as we said in the last example, a stock can go up forever, right? So theoretically, a stock can rise and rise and rise, and eventually we have to buy those shares back. We don't know what that price might be. So when you are short shares of stock, you have theoretically infinite or unlimited risk. And I want to make a point of this. The max loss on a short stock position is infinite. Now, why are we talking about stocks so much when this is a video series about options? Well, remember, when you trade options, there's always the possibility that you could end up long shares of stock or short shares of stock. And as a trader, we need to know where our potential reward is, but most importantly, we have to understand where our risk is.
Stocks trade in the stock market, which is a broad term describing where the regular buying and selling of publicly traded companies takes place. The stock market is made up of various individual stock exchanges and venues where investors can buy and sell shares amongst themselves through stockbrokers like Robinhood. Maybe you've heard of the NASDAQ, London, or Tokyo stock exchanges, but the most famous of them all is the New York Stock Exchange, or NYSE. The origins of the NYSE go all the way back to 1792, when 24 stockbrokers and merchants signed the famous Buttonwood Agreement. This agreement, signed under an actual buttonwood tree located on the actual Wall Street in Lower Manhattan, established the beginnings of the New York Stock Exchange. Now, over 200 years later, the term Wall Street is synonymous with the financial industry, and Lower Manhattan continues to be the home to some of the most important financial organizations and institutions in the US.
All right, so we've talked a lot about stocks in episode 2. Let's dig in a little deeper. Denver, can you show us how to find a stock on Robinhood?
Absolutely, let's do it. So you log into your app, you're gonna land on an investing page. You wanna navigate to magnifying glass. You see a little search functionality at the top. You want to select it. You want to start typing. Let's say Apple, for example. So APP, there we go. You select it. You see the stock price. You're going to get a lot of crucial information on this page. You can see the charting over weeks, months, years even. We're going to go down. We're going to get to the stats section. Very important. We're going to get to the news section. Analyst ratings. There's a lot of really juicy things here.
Speaking of juicy things, I see a lot of numbers under the stats section. Kendall, can you tell me about some of these stats?
Yeah, so in this column, you have very basically the opening price for the day, today's high price, today's low price. So where is Apple currently trading at today versus the 52-week high? So over the course of 52 weeks rolling, what was the highest point that Apple has reached in the market versus the 52-week low? Where was the lowest point that Apple was trading at over the last 52 weeks? Obi, you want to take away with the next column there? Explain some of that?
Yeah, there's a few things in the right-hand column. So Denver, you see volume, average volume, market cap. What this is really telling you is how big is the company and how frequent are their shares traded? So we use a term in trading called liquidity, which is a fancy word to basically say how easy is it to get in and out of a stock, an option. Well, shares of Apple, if we look at it, you've got a market cap of almost $2.5 trillion. Massive company, right? But then also the volume. Today alone, almost 58.5 million shares traded. Now, why is this important? Well, because when we talk about trading options, the more liquid a stock is, the options tend to be liquid as well. So later on in the series, when we talk about how to pick an underlying security to trade, liquidity will be one of those values we look at.
Got it. I want to kind of switch gears a little bit and talk about the two concepts that you brought up earlier. So being long a stock or being short a stock. Can you explain that a little bit more?
Well, I think we all know, for the most part, what it means to purchase stock, right? So you're purchasing this stock, you're putting it within your portfolio. That's being long. It's just some jargon that you can use to say that you own the shares of the stock. On the other hand, a little bit more complex is what's called being short stock. I'll let you take that one, Obi.
Let's imagine you own 100 shares of, in this case, Apple. And what if I said, I want to borrow your shares and sell them to Kendall? And right now, if we look at the price Apple's trading currently today is around, let's say right around $149.
Yeah.
Well, if I borrow your shares and sell them to Kendall for $149, I have created a short stock position. Now I have to give those shares back to you, right? So maybe later on, I buy shares from Denver, hopefully at a lower price, and so I profit by selling high and buying low, and at the end of the day, you get your shares back. A lot of people don't understand that that's a thing.
I would like to point out as well, when he's borrowing the shares from you, you don't actually notice that at all. It's typically a background movement. So the shares don't actually leave your portfolio at any point. You're still owning those shares. It's more of a background transaction that's occurring, and it's setting him up with that short position of the shares.
I see. Okay, that makes a lot of sense.
So in this case, the options trader here, they're, they can be right on either side of this.
Yes, and the reason why we bring this up, right? We're setting the stage with this idea of what does it mean to be long and short stock, because when we start talking about options, the potential result of owning an option or selling an option could result in having to buy 100 shares of stock or sell 100 shares of stock. But if I'm obligated through an options contract to sell shares of stock, if I don't own those shares, I've created a short stock position. When you have a short stock position, you have unlimited risk to the upside. Because remember, in our analogy, when I borrowed shares from you at $149, I have to buy those shares back at some point in the future to return to you. And what if Apple goes to $500 a share, or $1,000, or $10,000 a share? That's money I have to have set aside to buy shares back. So when we talk about understanding the risk of long and short stock, it's really crucial to understand the risk of being short stock.
Absolutely. I would like to point out as well, at Robinhood, you can't currently short stock, but there is this risk that you're exposed to when you do trade options, where there's the potential you could be exposed to a short stock position within your portfolio that we'd want to take action to correct as soon as possible to help limit that risk on the upside of covering that short stock position.
I see. All right, final thoughts. It sounds like you really can't talk about options without talking about stock trading, and that's why we're kind of diving in here.
Absolutely. When you trade options, you are in a way trading the stock. What I mean by that is when we talk about later on why you would trade an option or pick a certain strategy, a lot of it has to do with what your opinion is of where you think the stock will be by a certain date in the future. And so understanding the information you see on this page, whether it's the charting information or the 52-week high and 52-week low, you have to really become familiar with the stock that you plan on trading options, because the two are always linked.
I see. It's all coming together. On the next, options trading essentials.
Every option has 4 main specifications.
The underlying stock.
There are multiple expiration dates.
So those are your strike prices of your contract.
And the type of option, a call or a put.
Let's run through the options, Shane. Denver, can you show us?
Yep. All right, let's do it.
Thanks for watching the video. If you enjoyed this episode, smash that like button, leave a comment, and don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risks and are not suitable for all investors. Before trading, check out the link below in the description.